All right, welcome everyone at the panel. We're going to be talking about DeFi today. We have some really good panelists here today. So the format of this webinar is going to be Konstantin is going to have a super quick presentation about DeFi. Then we're going to have a panel that I'm going to be moderating myself, and then towards the end there will be a Q&A session for about 10 to 15 minutes. So for all of you guys that have any questions throughout the webinar or throughout this panel for really anything, just go for it. Ask it on the right. I'm going to be going through it throughout the panel and then picking the ones that make the most sense. But yeah, let's start with Konstantin giving a super quick presentation, and then we'll go right into the panel.
Hey, great. Hey, everybody. This looks like I'm a teacher in a Zoom session because I'm, the oldest guy in here. Jack and I are the elderlies. So yes, great to be here. I'll be very brief. Talking about very briefly, just really level setting DeFi, and we've got some real experts here. So they'll, I'm sure, have better and smarter things to say. So we can go to the next slide, actually. Let me see if I can do that as well. No. And so just as everyone knows, DeFi is a big thing these days. The way I always think about it, ultimately, it's just your digital bank. You can do on DeFi what you would do in the old days with your bank. You can go there and deposit currency, and you get interest in return. And there's different types of interests you can earn, and you can go there and loan money. And you leave certain collaterals. And what DeFi enables is to do that across all the different blockchain protocols that are around. And the big novelty here is the smart contract component, which means is that the bank is really not a bank. It's a systemic piece of software that does the if this then that. If this happened, then this happens, and that's it. And so the governance resides across the different government. It's actually kind of a more interesting subject because DeFi is also a concept that bridges chains, and so the governance components are intriguing, and an interesting challenge in the space. But there's a couple of things here. DeFi is composable, smart contract stuff. It's transparent, like all crypto should be. It's non-custodial, and you can crowdsource liquidity. And so those are all interesting components around DeFi. I never know what DeFi as a term is a little bit like decentralization. You can pack a lot into it. You can also pack very little into it. And so, it's really a placeholder for a lot of different types of activities that is done running derivatives on top of protocols, et cetera, et cetera. We can go to the next slide. And there's a couple of names we'll mention just so people have some ideas. There's collateralized lending, the Compound, Aave, there's stable coins. I'm sure some people are aware of Tethers. Here derivative platforms, Synthetics, Mirror Protocol, Perpetual Protocol, decentralized exchanges, Uniswap, obviously, SushiSwap, Curve, Kyber, Bancor, and lots of different others. So all those are different little brand names you hear that shop around different financial products based on the currencies that are run on the blockchain node. So we can go to the next slide. And and so kind of what I said, blockchain really is what enables this, just because it specifically the cryptographic components and the smart contract entity. Most of the current DeFi platforms run on ERC20 tokens. And so one of the things that are really intriguing to see over time is the merge coming hopefully early 2022 around ETH 2.0 and price implications as well. I think there's still a lot of misconceptions around how the economic process around ETH works. And so their ETH prices, there's a good chance, no financial advice, but once the validator, monthly validator waiting lists start expanding, et cetera, and the yield components initially will be high. It'll be interesting to see what happens to the gas costs, et cetera, et cetera. And so interesting little bits surrounding this environment. Very difficult to predict the macroeconomics, as always, with crypto, because there's just so many individual governance and technology crypto-centric subjects that can impact evolution. And then there's all the macro regulatory complexity on top of it as well. So I always feel like, you know, it's impossible to know where this goes in the short term. In the long term, Web 3.0 is the way this all will go. There's just no other way for us to sustain the current economic system really with the traditional infrastructure that's just so highly inefficient. And let's go to the next slide. Just one quick point, just because it's interesting. The use cases differ a little from you know, how this looks as an example in the US versus an emerging market. Only reason why I bring it up is from our perspective as Blockdaemon, or I mean, actually, personally, I'm very excited to bring a lot of these blockchain-centric technologies to emerging markets. I like mobile payment systems and things like that on one thing, and then on the DeFi side specifically, you know, we've seen what the ability to lend capital has done in the Western world. If that were available to emerging markets as well in a somewhat reliable manner, you know, it would create a ton of value and enable people to engage within their respective economic cycles a lot more efficiently. So that's a very exciting component here. And so it's not just us geeks sort of kind of trying to, you know, kind of make a dollar here. There's also something a little bit of a higher purpose. Next slide. Yeah, I'll leave that up. You know, Blockdaemon, we're sponsoring this. I'm not going to show you our stuff. We run nodes on protocol ones. So we're the largest node operator in the world. And so, you know, we power the underlying infrastructure from Bitcoin to Ethereum to all the major networks. And our customers are exchanges, custodians, financial institutions, anyone who needs high availability, throughput architecture. And then we're currently defining our path from layer 1 to layer 2. What integrations and plugins do we need to enable so people can you know, use core components of our platform to participate and build on top of DeFi? And so that's where we said, I'll stop here. And so there's a lot of interesting people here and looking forward to talk more.
Awesome. Thanks for the presentation, Konstantin. I think we can just briefly start by everyone giving a quick introduction about what you do and you know, just very quickly about your background, and then we can get started into questions. So Konstantin, since you were talking, just like really briefly, and then we go to Santiago, Sam, and Jack.
Sure. I'm Konstantin, the CEO of Blockdaemon. Blockdaemon is the largest independent node operator in the space.
Santiago?
Yeah, I'm a partner at ParaFi Capital. We're a DeFi-focused fund. This is all we do. We take a very active approach on governance, staking, providing liquidity, and we're users first and investors second. So happy to be here.
Sam?
Hey, I'm Sam. I do a bunch of shit. I'm the CEO at FTX. I've done some Serum stuff and used to be a trader.
Jack? You're muted as well.
All right, trying that again. Hey, everybody. I'm Jack O'Halloran. I'm the CEO of SKALE Labs. We are the team behind the SKALE network. SKALE is a blockchain scalability network that is multi-chain and Ethereum native. So we love DeFi. We love supporting DeFi projects, and pumped to talk about this today.
Awesome. So just one more reminder, please ask questions during this panel. We're going to have at least 10-minute Q&A session towards the end where, you know, we're going to try to get through as many of them as possible. But let's get started. So first question that I have, and just want to kick it off, you know, obviously DeFi got really significantly kicked off with Compound last summer, and now there is more than $60 billion in the total value locked. Without a doubt, everything has grown significantly, way more users, way more everything. How has DeFi changed from what it was last summer to what it is now? We can maybe start with Santiago, and then anyone else who wants to jump in.
Yeah, I'll try to be brief. I think like I would characterize last year as constructing like very basic money Legos and financial functions. Like Maker existed for a long time, but really like with the influx of new liquidity and users kind of really took off. And you see that in the supply, like the DAI, circulating DAI really taking off. You have Compound launching. And so last year I would say is like really like laying the foundational layers of DeFi. And of course, now you're at a point where Ethereum really is reaching kind of capacity constraints with high gas fees. And obviously, now there comes a time where I think you've proven out very basic functions. And, with L2s, hopefully you can have a more, I think like really good tech gets adopted because it's faster, it's better, it's cheaper. And I think we're coming to that. It's certainly not cheaper now, but I think this year, if I were to look forward, I think that's something that's really exciting where hopefully you can get interact in this ecosystem much efficiently. But of course, you'll have other ecosystems like Solana that are trying to do that as well.
Does anyone else want to jump in, Jack?
Yeah, I'll jump in for so I think the main thing is DeFi, from my perspective, DeFi is happening in more places and by more people. I think it was happening very specifically just on Ethereum by a very small subset of users. And now it's happening on Binance Smart Chain and Matic and Solana and obviously Ethereum. And then the Ethereum scaling solutions are all launching right now. So I think as of today, there were about 700,000 daily active users on PancakeSwap. And I mean, it's just, and hey, I'm an Ethereum person here. So, I think people have a little heartburn when they see that, but I think we all need to recognize, DeFi is growing and it's growing to more people and it's happening in more places.
Sam, do you want to share a perspective from Solana as well?
Yeah, there we go. I think that well, first of all, I'll say I'm surprised by how little DeFi's changed in the last year. I think if you told me a year ago that, when sort of yield farming was just started, that fast forward 1 year and some of the base trades in crypto were going to be taking a random shitcoin that just launched, parking all your capital in its yield farm and making 1% a day, I'd be like, Jesus Christ, really? I guess that makes sense, but come on, guys. So yeah, that's sort of my response. But no, I mean, whatever. I like Solana. I have strong views on it. Obviously, I don't necessarily need to. I think most people probably heard of a lot of them, but I basically think a lot of people like using the word fast and scalable, and that's sort of a qualitative statement. But what matters is quantitative statements, and I think a lot of the things that use those words break down when you start to dig into exactly what numbers people are talking about and what numbers people need to be talking about. And I think that Solana is one of the only things that has a really compelling pathway to scaling to what the upside of DeFi is, which I think is like about million TPS, give or take, in one composable non-sharded ecosystem. So that doesn't mean Solana's going to be huge. I think it might be. I think maybe it won't be. But I think it's hard to see most of the other current tech solutions getting there. Maybe nothing will. Maybe there will be a new one that comes out and sort of eats everything else's lunch. Yeah, I don't know. I think DeFi has been sort of disappointing in how little it's developed over the last year. I really hope things would go faster. There has been some progress, and I don't know. I kind of like the progress on Solana. I guess that shocks people. But I don't know. It'll get better. I hope.
Santiago, do you want to respond to that? Do you feel the same way that not much has changed? I kind of see you seeing the face.
I kind of feel okay. So I hear the point. Like, there's always going to be speculation, right? There's always going to be the yield farm, the opportunity, those type of protocols that launch and just create a farm. There's no innovation. It's just copy pasta. Like, I get that, but that's inherent in any industry. Like, this is not true for DeFi. But I would push back in saying there has been some traction, there has been some inherent innovation in the space. One of the things that I would concede is that is underwhelming is the kind of risk management bucket within DeFi, option protocols haven't really taken off. So you have Perpetual Protocol and Open and Primitive and a few others that just haven't taken off because you can't do cross margining. It's like Hedgehog too. It's very expensive relative to something like Deribit. So for me, I was really excited about seeing a decentralized BitMEX, and I think there was a void in the market that was created last year. It hasn't really come to fruition. But look, I mean, that's not to say that it can't be solved. I mean, I think sometimes it's hard to appreciate when you look at there's always going to be a lot of noise and a lot of garbage out there. And unfortunately, I think that takes the headline and that takes the attention. But I do think talking to teams and being very actively involved with them, there's been a lot of innovation, not a lot of which may be visible, but I think there is a lot of research, a lot of projects building and thinking about. I mean, these are hard problems to solve, right? And so I would agree with Sam, like these things generally take a long time. That's been true for Ethereum, like L2 research, and Vitalik's been talking about this since day one. I think it's hard, right? And as a founder in the space, and I'm not one, but I just talk to them a lot, is you get pulled in a million directions, and the space is the community constantly is asking for stuff, and the next sort of like yield farm is enticing, but no, I think these things take time to develop. But one of the things that is encouraging is, again, just from first principles, this is a space that is able to attract a lot of liquidity really quickly. I mean, the fact that you're able to certain protocols scale to over $1 billion in TVL in like hours is encouraging, because that's, I think, the interesting premise of having these global capital markets, like untethered pools of capital. So
what hasn't been, if you're saying that, like, sure, some things have been disappointing, but other things haven't, what hasn't been disappointing over the last year in terms of DeFi growth?
I mean, I would say, like, from a use case perspective, like the ability to just be your own bank is something that is truly transformational. I mean, I think, like, I get it. Like it's something that, like, Aave and Compound to me are pretty interesting. And I think, from my perspective, you don't necessarily need to reinvent or do rocket science. It's just pretty awesome to see that, and the growth that they've exhibited. And Aave doesn't have any incentives until recently. And so for me, that's, I mean, a question for you, Sam, what is it that you're looking for that has been underwhelming in DeFi?
Scalability solutions, having derivatives protocols on chain, having like actual composability used between projects and not just sort of like in theory usable, having social media on chain, having, I don't know, that's sort of like a start, but there's a lot more. I think, like, there's just a ton you can do with it, and I think, like, it's hard for me to name that many projects that I'm that excited about that I think have come out over the last year. Obviously, other than everything on Solana, which is perfect and has no flaws. No.
I mean, okay,
but outside of that, like, seriously, I do find it, like, surprisingly hard to find, like, that many projects that have come out that I'm that excited about over the last year.
So a follow-up question.
I mean, I'll point to two and very quickly, like, I was just gonna say really quick, like, what Sushi's doing, I think, is interesting. Like, Andre's vision of Dare Swap and capital efficiency is interesting, and hopefully launches soon. Like, Kashi's interesting, what you're doing there. Like, I find that approach to capital efficiency interesting, and the other one is Terra. Like, it's like probably the ecosystem that has really the only non-speculative, like, true organic demand for, like, the stable coin, because it powers a lot of e-commerce in Korea. And the scale that they've gotten really quickly, and the entire ecosystem that's built around that, to me, is not underwhelming.
And just a question to follow up on that. So Sam, you're convinced that a lot of this will be scaling in L1s. I think Santiago is more on the side that a lot of this will happen in L2s and Optimism, Arbitrum, ZK rollups. So can you quickly, maybe Sam, if you can start, just quickly summarize, like, why you think this and why you think rollups are not going to be the ultimate solution?
Yeah, so I guess I'll give two answers. The first is, like, when you have these sort of rollups, the traditional view for them is that you've got, like, a lot of different independent ones, and you basically don't really have composability between them, not in sort of a useful sense. And so a lot of the proposals I've seen this are, like, rollups with, like, 1,000 TPS each, and that's, like, not even enough to run, like, one medium-sized application, let alone, like, a composable ecosystem of large applications. So I think you need to think a lot more ambitiously than that. I think you need to have 1 million TPS in one composable ecosystem, with true real-time composability, in order to launch the most exciting apps. I think if you don't have that, then you're just, like, missing out on the upside. And basically no layer 2s are aiming for that, unless by layer 2 you mean Solana treating it as a layer 2, which you could do, right? You could just take a layer 1, but change that 1 to a 2. But then I think my question would be, why bother? Like, why not start with a good layer 1 instead of, like, a dysfunctional layer 1, and then try and put a layer 2 on top of it to, like, cover over the problems. I don't know. It seems like sort of like, I don't know. Certainly, if we had, like, a completely non-scaling solution on FTX, and then, like, you know, we're going to try and scale it by building a separate fast thing. We would not keep the slow thing as the core bottleneck, and then just like, you know, try and run pieces on like you know, we you know, not have that slow thing. And so I think like, you know, that's sort of like my honest sense of it. Is that first of all, like the layer 2 solutions that I've seen are mostly like extremely unambitious and just not shooting for the actually exciting things. And second of all, that you know, even if they were, I think like why not just have them be a layer 1 then?
Jack, do you want to chime in here? And I know you must have some thoughts as well.
I'd love to. So actually, I think those are some fair points, but I'd like to call out this whole premise around app-specific blockchain networks. So multi-chain networks that can grow in a scalable fashion. As more nodes come into the network, more transactions can come into the network, and more blockchains can come into the network. So you see this with SKALE. I think you know, Definity, Avalanche, others are also having, you know, similar architectures. And because I think Sam's correct, if you have a finite capacity in very disjointed scaling efforts, it's not very optimal. So the approach SKALE takes is, hey, it's Ethereum native, and that the mainnet helps orchestrate and manage security of the SKALE network, but you're able to consistently add more and more blockchains that are not atomically composable, but composable and always less than a second away to be able to update state between each other. So I think
what's the TPS of one of those?
2,000 for one.
So you're gonna need to get like another few orders of magnitude at least, even just for one of them, where like you can't even run a single big order book.
I mean, so 2,000 transactions per second is, you know,
not enough. Yeah, but
it's a lot throughout the course of a day. It's more than.
Oh, if you can store it up, sure, but you can't, right? Like you can't like just like bunch up like all this excess potential, and then when things get busy, use 100,000 TPS a sec. Like FTX has more than that already, and like.
Yeah, how many transactions does FTX do per second?
Transactions, I think it's probably like 50,000 to 100,000.
Okay.
Sorry, it depends on how much you can fit in a transaction. Yeah, you could get a number between like 10,000 and a million, depending on how you define it.
Uh-huh.
And this is actually, if you look at basically any big app, you're going to find that like 2,000 is not really enough. It's sort of like pushing it at best.
Yeah, and so that's why it's scalable. You add more resources, you purchase more compute from the network, and that's the design.
Well, but in particular, you can scale up a single shard of it, or is that just like adding more shards?
You're adding more shards.
So like tell me how you take a single order book and you shard it, given that like two people can't both lift the same offer.
Yeah, so I think it's a fair point. You don't have atomic composability between shards, but you can also, I think the goal is to coordinate them together. But I do think it'd be nice to get to a point in DeFi where we have an issue of 2,000 transactions per second.
We already have those on Serum, but sure.
But Sam, do you think that like for applications?
Let me ask you a question. Like, why haven't you? So, like, I appreciate the like. If you talk to the Solana team, they'll tell you like, hey, when you think about how they're approaching scalability, it's like a step function improvement, and I get like, but that comes at a security cost, and then like you're making a fundamental trade-off, and that's okay for certain use cases. I'm not like dismissive of that. I'm just curious, like.
How secure would you call the current Ethereum network?
What was that?
How secure would you call the current Ethereum or Bitcoin networks?
More secure than Solana.
And what's your metric that you're using for that?
Just a number of like validator, like number of like miners, and like nodes.
I don't know. How many mining pools does it take to get a 51% attack on Bitcoin or Ethereum right now? I think the answer is like 3. I think the answer is like an order of magnitude higher on Solana. I'm not saying like, I'm not trying to make a strong statement here that like obviously Solana is more secure. I think that'd be a crazy thing to try and claim, but I think it's like less trivially, like you're saying this as a fact, as if it's sort of like doesn't even need to be justified. And I think you're probably reaching a little bit with that. And I'd be interested in hearing like why you think that's so obvious.
My point is that like, why do you think that you haven't gotten the number of users and scale relative to Ethereum. Like, so like I get the point.
Oh, Ethereum was
maybe
first.
Solana's great, and no, I understand
That's a huge fucking
I understand
advantage.
that, but like, I understand that, but like, what's going to take for you guys to scale to the point of Ethereum? Because there are certain trade-offs that institutions or folks like Visa are taking, and maybe you could argue Visa is just approaching this as a pilot, and you know, settling USDC on Ethereum. But like, I'm curious from your standpoint, why didn't they choose Solana first?
I mean, you know, I think one thing is it's a PR statement, but and Ethereum's what people know. I think that's just a huge part of this. You see this everywhere. Like, incumbency advantage is absolutely fucking massive. And like, to be clear, I think in worlds where DeFi doesn't get that big, ETH probably just wins, right? Even if it never gets ETH 2.0, because it's just like, you know, really hard to unseat an incumbent unless you have like a really compelling reason for it. And that being said, I think, you know, Solana's been around for 1 year. It's grown a ton. It already has done more transactions in its lifetime than Ethereum has. You know, I think Serum Dex might be the most liquid Dex in DeFi. I'm not sure about that. Uniswap might be more liquid. I'd be interested in looking at it. I don't know. I think they were cooler products. I think there's been a ton of growth for like 1 year there. I don't think it's overtaken Ethereum, certainly, in terms of like number of users or TPL. But I think it's, you know, growing pretty impressively for like 1 year in, all things considered. I don't know. That's like my sense of it. But yeah.
Well, maybe we can, you know, yeah, there's lots of different benefits per different protocols. Obviously, adoption and size of Defi, because there's so many different factors that come into it. One thing I want to say, like just from a much more infrastructure node perspective, right, since we run nodes on all these different networks, is what I find intriguing around DeFi currently in DEXs ultimately is also the concept of bridges that currently are, you know, very popular, right? Like, so everyone's bridging into anything else. And from an infrastructure perspective, what I find intriguing is that the technical, let's say, excellency of them is at the same level that node infrastructure was in 2017. I feel like they're very inefficient and still very clunky for example, institutional grade usage if you were to connect it to anything that needs guaranteed settlement in particular timeframes, for example. And so just throwing that out there, I think we're at an interesting stage, but the core infrastructure, specifically interchain, you know, still needs a lot of work. And then to Sam's point, security ultimately, you know, is, I mean, decentralization, for example, or node count is one of probably 100 metrics that matter. And you know, it's actually interesting. We find some of the networks that don't look like they're very secure because they have less validators often are more secure because they can actually upgrade and manage. You know, have a smaller pool of people chiming in, and so there's security looks different at different stages of protocols life. And so it's very difficult to compare those. But I'd say on the pure technical infrastructure side, we're very early when it comes to actually making this easily composable and instantly guaranteed settlements, unless you plug in other financial solutions that ultimately create other middlemen.
Sam, you mentioned running social media, for example, on a blockchain. Is it necessary to have something like a blockchain running infrastructure, you know, like of a social media site? Do blockchains make sense for this use case? I don't really see a compelling reason for like why wouldn't you just do it in a centralized way? But just curious, what do you think?
Yeah, I don't know. I mean, I think like, you know, a lot of this we're gonna have to see. I mean, for finance too, you know, we're gonna have to see how compelling it ends up being. But I think there's some reasons, right? Like, I mean, you can look at what happened to, you know, what people said about Zuck when he didn't ban Trump, or sort of fake propaganda sites during the 2016 election, and then the feedback he got when he did ban Trump in the 2020 election. He got shit on both times, and you then see sort of like, you see this sort of same thing happening with Twitter, and I think that it's a hard problem to decide like what governance should look like on social media. I don't think there's an obvious answer. I think one possible answer to it, I don't know if it's the right answer, but it seems at least interesting to me, is that basically, you know, you can have a permissionless core of social media that's on chain, but then, you know, anyone can build their own GUI on top of it, and, you know, can have whatever moderators or censorship or lack thereof they want, or anyone can just have an uncensored version of it that they can run and access. And it gives a ton of flexibility, and it also means that a ton of different social networks can all interoperate with each other in terms of posts. The same post can natively live on the equivalent of Facebook and Twitter and everything else. You don't have to have these sort of like isolated systems. If it's all sort of one underlying protocol with different, UIs and base use cases and default channels and parsing and whatever else you want there. It can natively interoperate with finance, and there's a lot of cool things you can do there. I don't necessarily know that it's going to happen, but I think there's potential.
We're getting a little bit off track, obviously, so I want to go back to DeFi. So we saw Aave yesterday kind of accidentally announced that they're thinking about doing like pools for institutional customers where it's going to be shielded off from certain transactions, certain customers. Is that something that is going to start happening more in the future? And is that something that is necessary to get institutions adopted? Maybe Santiago, you can start.
Yeah, it's something we've worked with Aave for quite a bit of time. I think this is going to be explosive, right? I mean, when you have really financial, like there's really, the way I've thought about DeFi is there needs to be some regulation, and just imagine like KYC, trusted pools of liquidity where you actually know your counterparty. So in this case, it's a more like a controlled environment. It still has all this, like the security premise like of Ethereum, but it's just a kind of a quasi walled garden where, you have all, you just know who's in the pool, right? And this is obviously, it goes back to the regulatory concerns around like the traveling rule and some of these things where if you don't know your counterparty, then like regulators are trying to like understand how that would work. And this would just be say that, you're a financial institution, you're JP Morgan, you go to this Aave trusted pool of liquidity, you're able to underwrite mortgages, you're able to, do X and Y, and everyone that is in this, kind of controlled environment. And I ultimately think that is how DeFi really scales from, current TVL to like orders of magnitude, right? Where this is what it, from my perspective, when I talk to like, I used to work at JP Morgan and some of these places, like they're on the fence for this reason. And I think Aave is taking the right approach to getting some of this TVL on chain.
Yeah, and one thing there I think to point out is, all the large banks, AML KYC requirements are, you just can't trade with a counterpart. You can't KYC on an institutional level. The insurance complexity and regulatory punishments would be way too severe. So I think the interesting question is really, obviously, there's these two philosophies, right? Which is, do you build these systems and one system just replaces the other? And then there's or do you sort of slowly try to merge them together and sort of find sort of ways to kind of slowly blend them into each other over time. I think on the DeFi side, I still feel it's very early with institutional grade adoption, where there's curiosity. I think underwriting a mortgage with digital asset and stuff is still a little out, at least at the scale that would matter. And so I'm intrigued to see where that goes. But it's intriguing. We always we face that as node operators in a lot of different countries, and how do we stay compliant? And we have investors, and some of those are institutions, and so it's really complex to engage in the system in this manner. And then the question is there a regulatory solution to be had in a decentralized manner? Is there a software piece that can KYC this in a way that protects identity and freedom of distribution while doing what the regulators at least pretend to say they do, which is ultimately, avoid too many mischief and screw-ups.
One thing that I've noticed by like basically onboarding some of my friends is that DeFi is still incredibly difficult for them, and it's because one is it's relatively expensive to interact with, and second, it's just really unintuitive for everything. I mean, including Solana and the wallets and everything, it's still really hard to do for normal people. How do we get to a point where, my more non-technical friends and basically people that don't interact with DeFi on a daily basis, like how do they get comfortable with it? Is it going to be through fintech applications, just plug into some of the DeFi protocols, or like how is this going to happen? Are they actually going to be interacting with the blockchain directly, or is that just going to be through some sort of an intermediary and maybe just benefiting from the yield? That's something I've been thinking about as well, and I'm not convinced that they actually need to interact with the blockchain itself. At least from the experience that I've had with a lot of those users.
Yeah, and they don't. I mean, and I think that the large fintechs ultimately that going to carry that battle are probably folks like Apple Pay and Robinhood and all those type of folks. And you will simply benefit from the yield that's generated by holding certain assets, probably.
I feel like there's still like the target is remove the middleman. And so if you want to maximize that yield, you want to maximize the value back to the user and control back to the user, you need to get the user interacting with the blockchain. But right now there's a ton of friction. So I feel like the answer comes with wallets, and then people that have software solutions that more elegantly connect through Web3 and connect to blockchains, and while also not giving up on security, right? Because more friction and usually goes in line with more security. And so that's the equation we need to solve for. And in general, DeFi is like, like to use a basketball analogy, like we're hitting these NBA line 3-point shots and we're missing a lot of the layups still. Like we need normal people moving their savings accounts into DeFi protocols, and they're going to start capturing far more return. But we need to do it in a way that, they don't lose their money, they don't lose their private keys, et cetera.
Yeah, I'd say I would argue that wallets like Argent and Dharma mirror a Web2 experience. Obviously, the key management component of Argent is actually really intuitive from my perspective. And I would argue that most people could get away and around using it. Of course, the gas fees and some of the other components add friction to the equation. But for the most part, I would, if you were asking this question a year ago, I would tell you, yeah, there's a lot of friction. You need to abstract away all complexity for users to interact on chain. But I think it's you're at that point where it's actually on par with some Web2 apps. And I think, of course, like Argent and Dharma kind of come close and approximate that. But there are other issues like why crypto? Why should I interact in this ecosystem? Why are yields this high? There's a lot of these ongoing skepticisms. But if I think in 5 years, 10 years out, I think there's always going to be a role for existing incumbents that have a lot of the distribution to Robinhoods of the world that essentially can offer this service to customers, right? I mean, Circle is already kind of doing this with their high yield savings account. They're capturing the yield off on chain, working with counterparties. But the value proposition of the customer is really strong. It's hey, I can give you an order of magnitude higher of interest rates. And I think for them, it's super compelling because they're going to ultimately, win a lot of customers from the Wells Fargos of the world. So there's competing forces of why I think DeFi really takes off. On one end, you have the Circles of the world that are trying to eat JP Morgan's business. And another, you have bottoms up crypto native protocols and apps that are making it easier by the day for customers to interact on chain and not thinking about all the complexities attached to them.
Yeah, I just find it a little bit odd that we've had, we mentioned this already, there's 500,000 plus users on PancakeSwap buying into dumb meme tokens, but they don't find DeFi compelling enough to earn some yield on their savings account. And I think that's kind of worrying, is that there just isn't anything that's compelling enough for normal people to start using. But maybe that's going to change with
well, I think you're going to see it indirectly, right? I think in a year's time, anyone anywhere holding an ETH token is automatically going to earn interest on it. And so I think that's how that's going to look. But yeah, I'm curious. I'm also curious from an exchange perspective, Sam. What are your sort of thoughts for the next 12 months in terms of architecture? And also the sort of yield components and all that stuff, when people come to you guys, because you're kind of an intriguing place because you connect sort of the equity world with the token world, right? And so curious what you kind of think and make of what's happening on your infrastructure and integration side that you're excited about.
Like integrating with DeFi or just crypto exchanges in general?
Actually, I mean, kind of both, right? So when do you see those kind of converge, right?
Never. I don't know. Maybe sometime. It's not clear to me. So I mean, I think it might happen. I think that one thing I would ask is why do you think it would happen? What are you imagining will happen in that convergence? What is converging there? I'm sort of not.
Well, I'm more curious, for example, if you start offering people who hold particular tokens on FTX automatic yield.
So it's an interesting question. So what we do right now, which is not the best possible answer, but it's the most general possible answer, is we have borrow lending. So if you go to FTX and you go to our lending portal, for most of the tokens on FTX, users can lend them to each other. And, there's just an auction every hour for the interest rate. I'll get to in a second why this is not optimal. But the nice thing about it is it means that like we don't, as FTX, don't have to like, sort of like pay attention to every yield farm that comes out and be like, oh shit, like what's the interest rate here? What can we offer in terms of staking? Instead, we just let users figure that out. And, if there's a place where you can stake, Aave for 20% per day yield, then users are going to be bidding up borrows on Aave in order to borrow it, and that's how you do it, right? Like if you want to get yield on Aave and FTX, you lend it out to the people, and then the borrowers will go borrow it and stake it for yield. And so it's a really nice general answer to that. It's just super clean. The downside of it is that it has to be collateralized, because FTX doesn't sort of like have custody of it once you stake it, and once you take it off to stake it, you still got to keep a bunch of capital there on FTX, as collateral for your borrow. So it's fine if the yield of the biggest things is massively higher than the yield on the least yielding things, because you just put the things you don't need as collateral on FTX. But in a world where all your where everything just has massive yield, you still have this net collateralization problem. So the other thing we can do is actual staking, where basically you just go ftx.com/staking, you stake things there. We've done that for a few assets. It's basically just because it's not scalable that we haven't done it with more. It's just like a lot of pain to manage this for a bunch of assets. We may do it for others, so it's like there are real advantages to it from that capital efficiency perspective. The third thing we could do there, which I think is super fucking awesome, and I hope we're gonna do, is accept LP tokens as collateral. So then you can go borrow what you want to stake, go stake it, get the LP tokens, bring them back to FTX, and use as collateral to take down more borrows. So then you get rid of this capital inefficiency. It's super generalizable, sort of. It's a nightmare for FTX's systems because we need to be able to price from a risk perspective and liquidate, whatever that means, LP tokens in a generalized sense. So it's not like it's a trivial thing to do, but I do think that's like another cool direction you can go there. I think from a yield perspective, that's most of what FTX is doing right now. The other things, obviously, there's blockchain integrations, and it takes time to add a new blockchain, but we do it. There's certainly value to it. Obviously, the gas fees are driving a lot of this. For a while, we're just eating gas fees. We had to stop doing that in some cases for Ethereum. It's just getting too high. I think the most interesting thing we're seeing there, which it's not, it's semi-public. Like this is sort of like a weird dynamic which is playing out half in the public view and half outside of it. But it's a sort of like proxy war over which chains are going to replace Ethereum for exchange transfers. I think it's pretty clear Ethereum's not going to be used as a means of transfer, except in as much as you need Ethereum-based things to stake at the end. It's just like too slow and expensive. Already, exchanges are sort of like one by one adding different chains as options for standard coins. The problem is that they're not agreeing on which chains to add. And so now you get this thing where, whatever, it's not going to be shocking, right? Like, FTX has Solana tokens, versions of most things. Binance has Binance Chain, BSC versions. Hopi has Hiko. And it's just like getting, huge proliferate, and it's actually a huge pain to manage. We have like every day we just have people depositing Hiko chain tether. Like, oh geez, we don't actually credit Hiko chain. We get huge support tickets every day. Like people sending random ass chains of random coins. And then really frustrating coins with chain migrations for no reason. Sometimes it's justified, usually it's not. And I think they don't realize exactly how much it destroys things when they do. It's just it so destroys the liquidity and the deposits and the withdrawals. And so that's sort of another interesting piece of this is just managing those transfers. And I think it's unclear exactly how that's going to play out long term. I will say that BSC set the tone for that. It was the first mover there. It made a huge wave, a huge fucking impact, huge adoption, and also sparked huge backlash at the same time. Yeah. And so interestingly, we simultaneously saw huge adoption for BSC and huge increased demand for Solana from other exchanges. I think seeing it as a neutral fast chain. And I don't know. I don't know.
I want to let me ask one other question just from an infrastructure perspective. So yeah, first and foremost, I want to make sure if you guys think about adding more chains and staking, obviously that's our bread and butter for exchanges, because we abstract away a lot of that complexity where you have to actually navigate the security and running chains and nodes, et cetera, et cetera. But what I'm curious, one thing you said is that I want to touch on, which is really intriguing, because most of the transaction actually happening on any crypto network is from exchange to exchange. You know, like the whole nature of this is actually it's fairly based on people trading and exchanging thing. And I do want to break a little lance for one of my old favorite projects, the Lightning Protocol, on Bitcoin, because Bitcoin obviously was very problematic in itself for a long time between exchanges, where still the bulk of transactions actually physically occur. But you're absolutely right. I find it super intriguing how transactions are handled. And we see that also on the node layer now with BNP and others, where folks are asking to run nodes on the respective exchange native transaction networks that are going to become bigger, and it'll be interesting how those eco wars work and how they bridge into others. You mentioned LP tokens, and I'm curious, so do you mean like Uniswap kind of LP tokens that are usable directly on FTX?
As collateral.
Do you see that work with, like, for example, a Binance over time?
As in, will Binance accept them too?
Well, if you would, or if they collateralize
9 months after we do.
Yeah.
I think if one exchange does it, you'll see others following eventually. At least some others will. I think there's a lot of design space there. And I don't know exactly where that's going to end up. I think like the astute observer might notice, I think it's like a few places we leaked that we were thinking of adding Uniswap LP tokens and SushiSwap LP tokens as collateral on FTX. I don't remember where. I think there's like some ticker drop-down list somewhere that includes some very weird tickers. We didn't actually roll it out. One of the awkward things we ran into is like the price of these things. Like a single LP token turns out not to be worth like $10. I can't remember which direction it is. I think it's worth like $1 trillion, but maybe it's like a trillionth of a penny. I don't remember what the denominators of these are. And it's like super awkward. Like, you could have like milli LP tokens listed, but no one wants to deal with that. I don't know. There's a lot of UX things here, and then liquidity is another one, right? If you're using it as collateral, that means that if you get liquidated, somehow you got to turn this LP token into usable shit. And obviously, theoretically, it can happen. That's not like an unsolvable problem. But like, what does that mean? We have to have order books for all LP tokens? If not, like, who the fuck is borrowing these things? In the case of liquidation, like, how are you pricing them in real time? Are you like there's sort of a lot of nuances of adding anything as collateral that doesn't itself have a liquid market. But it's theoretically doable, and I think it would be pretty huge. So I don't know. I'm pissed we haven't done it yet. I'm mostly pissed at myself for dropping the ball on that, but hopefully we will.
All right, we're getting closer to the end, so I'm going to start asking some questions in the audience because we have a lot of them. One interesting one is about kind of multi-chain projects, and then basically, like, this is one thing that I'm worried about slightly as well, is that there's now like tens of different chains, Solana, Avalanche, multiple different chains, and projects basically just building on them, and you get a lot of just a lot of dilution there as well. And my question is, like, the person's question is, should projects actually build multi-chain, or should they just focus on one chain like Ethereum? And there have been some different approaches. Like Sushi does this, for example, where they deploy on different chains, and some projects like Uniswap are more just focused on Ethereum. So what do you guys think is the right approach? Maybe Santiago, you're the right person to start with.
Yeah, I've spoken to this with a lot of teams like Sushi and Bancor and Curve, and at the end of the day, like I see that as the benefits of launching in multi-chains are twofold. I think one, it can be a good sandbox to test different kind of modifications to a particular protocol, and so or at least envision what an L2 could look like, by launching an Arbitrum, or just kind of foreshadowing what kind of that level of activity could look like, and or different users as well, right? I mean, I think the user in Binance Smart Chain is much different than the one in Ethereum, and so getting a good handle of what do users actually value there, and kind of the feedback that they give you. So I see it as a good testing ground, a sandbox. The second benefit, of course, is just like it could be a good acquisition funnel. Right? Why not? Like, if it's a trivial deployment in Avalanche or Binance Smart Chain or some of these EVM compatible chains, it's fairly trivial to just go and launch. I don't think it's a ton of distraction of dev resources, but it does give you, I think, the ability to capture that user, and a user that is perhaps using Sushi in in another chain like in Binance Smart Chain, just becomes more familiar with Sushi and the UI and how it works. And so, I think one of the interesting things even in Polygon and BSC is I think that it just opens the for instance, like the flow, right? Talking about friction, right? Like how to improve that for users that like can approve things very seamlessly. And so I think by and large, I think it's net positive. Where I haven't seen it be as positive is I think it's relative. The downside of all this is that there's relatively little activity in some of these like deployments, and so they take time to maintain. And that could be the only criticism that I could see from teams kind of diverting resources to a multi-chain strategy at the moment.
Yeah, I'm seeing it firsthand. I mean, there's all the kind of usual suspects are, I think we'll see a lot of action on Scale in the very near future of DeFi projects coming over. But there's a very clear strategy to acquire users where they are, and so you see people having less like religiosity towards a single chain or scaling construct and more thinking, okay, like there's users on these blockchains, I'm going to where they are. And I know that people will be there to pool liquidity. People will be there to get early adopter advantages. And, I think this strategy will be effective for probably the next 6 to 12 months. And then you're going to start seeing some more consolidation as it's all a game of users, right? And if you go to a new blockchain or you're on a current chain and you're just not getting the pull through and the usability, and then, the friction's not worth it.
Yeah. And another follow-up question we have is kind of regarding regulation. We have a lot of questions coming in. There's some news about Binance as well. But how will regulation affect how DeFi kind of functions? Do you think that there's going to be a crackdown either from the security side, but also just from the KYC and AML side in the US? Is that something that people should be expecting or not?
I don't
Sam, you're
think
muted. Sam, you're muted.
I mean,
yeah, it could happen. I don't know if it will, but it could.
Yeah, fairly likely.
It's always possible, right? I mean, we've always had these regulatory walls of worry that we need to climb. Since forever. I do think that generally U.S. regulators understand that there's a lot of innovation in this space, and that continues to grow. And being pro-innovation is, I think, and will continue to be a key kind of policy of at least for regulators. But of course, we saw it in November, right? This midnight ruling. There's always that possibility, and I think this year probably thematically would be how do you do this in a kind of KYC somewhat like verified. The message candidly is like DeFi is kind of a closed system, so like if you regulate the on-ramps really well, it should be okay. But of course, I think you can't take, in a perfect world, you make them understand that you can't take existing regulations that fits old paradigms to regulate new paradigms, and you need kind of a new framework to understand that. And so generally it's kind of frustrating that we haven't had a lot of guidance on a lot of things. But on the flip side, I think with that ambiguity, I think generally the regulators have been somewhat more thoughtful than in other jurisdictions like India that just outright like ban it. Whereas in the US, perhaps my sense in my interactions is that they want to be a little bit more thoughtful in how they regulate this. So
yeah,
my 2 cents.
I agree, but I just want to go back. I think the most important part of DeFi is the D. If you don't really have decentralization, you then have very high bars to pass for KYC AML, and there's rules you must follow. If there are addresses interacting with smart contracts, it's a different framework. And so I think actually maintaining decentralization while we get growth is the answer, without having to have incredibly cumbersome KYC processes. So you kind of see that with some of these NFT projects that have a centralized choke point.
There's also one really good question about VC and kind of how it relates to DeFi, and I think Santiago again probably has the most experience here, but I've noticed this myself as well, is that like some of these DeFi protocols now they're basically pre-market and they're raising at like $30-40 million valuations before really accomplishing anything, and they're oversubscribed somehow. So is that something that's concerning to you guys? And does that just show that the market is overheated, or is that something that's sustainable and something that's like kind of just comes with the adoption, or at least with the boom?
Yeah, market's overheated in some ways.
Yeah. Yeah.
The problem isn't the raising itself. Like the raising is fine, given that those raises turn out to be good for the people who bought into them. The problem comes before it, or the problem is the fact that like those that every single token goes up right now, which sort of the fact that those do turn out to be good.
Yeah, I think it's a sign of the times. I think this is one of those knee of the curve moments where we're actually transitioning into a real decentralized finance infrastructure, and Web3 is on the rise, et cetera. But yeah, there's going to be an 80-20 or 90-10 culling at some point, and you're just going to see, just the good projects and good investments pull through.
Yeah, one thing I think is worth noting.
Disparity. I was just going to add, I do see a little bit disconnect. I think a lot of VCs are focusing on the private markets. It's a function of they're raising larger funds. They want to do logo deals and play the J-curve Ponzi. Where I just see a lot of value in public protocols. Like look at Maker. I mean, this is not financial advice, but there are certain things in the public markets that have much, much more compelling and still similar kind of asymmetry. I mean, if you take the long view, right? Of course, if you just want to like invest in a 10, 20, 30, $50 million thing, and okay, you just flip it. And like, I understand that kind of game. We're long-term focused. And so for me, I just continue to believe that like, if this truly is going to work, I think you could argue that a lot of this is just priced at option value.
Yeah. One thing I'll say is that like the fact that some projects have insane valuations doesn't even necessarily mean the market is overpriced in general. And I think maybe the thing I'd most compare this to is the .com bubble, where, in one sense, yes, there is a bunch of things that in retrospect were crap and never going to be big that had insane valuations and then just crashed when people realized that. But on the other hand, if you just blindly bought tech stocks at the top of the bubble, you'd be up like a 1 trillion% market today. Because what was going on was not that tech was net overvalued. It's that people didn't know how to value different tech companies yet. The investors didn't yet know how to distinguish between the great tech companies and the shitty tech companies. But in fact, tech as a whole was going to go massively up. And the tech sector is, reasonably priced overall. Some things were overpriced. Some things were massively underpriced. I mean, buying Google has been amazing. And so I think what I would say is like, I'm not saying it is or isn't overpriced or underpriced right now, but just because some projects seem sort of ridiculously overpriced, doesn't mean that the market is too hot overall. And in fact, like a lot of people here, I think would say that they think that DeFi is cheap right now compared to where it will be in 5 years, which I think is sort of a way of saying it's not too hot right now, the market. And so I think the biggest thing that I would say is like, that maybe there isn't enough price differentiation between great and mediocre projects right now.
Yeah, that's one of the things that I would add here is that's a great point. I mean, the fact that we continue to bucket crypto as like one bucket, everything like one size fits all, is just emblematic of how early we are. And it reminds me of like after the tech, back to Sam's analogy, which I think is great. Like in '99, like right after the bubble crash, people didn't really understand how different Amazon and Google and Salesforce, how different like software as a service was in the license model, and understanding how to value that and the different unit economics. Like it's not that Pets.com was a terrible business, because then Instacart came along and it's a better business model because there's just more infrastructure, it's easier, like your OpEx line just compressed like orders of magnitude. And so I think we're in this still state of this industry where there's not like, people don't like have a good valuation framework, and these things take time to develop. And I look at DeFi protocols much differently perhaps than others, right? But the big divide that I see is there is a very productive ecosystem. There's productive like crypto protocols, and there's non-productive like things that just serve very little value. And I think that divide right now, of course, like I wouldn't make the claim that the crypto will uncorrelate. I think it still very much is a risk on asset class, and it will kind of trade in line with Bitcoin and Ethereum. But over time, I think we will see a dislocation in how these things trade and the correlation that exists within crypto.
Cool. Yeah, we are slowly running out of time, so I'll just ask you guys to give me one crazy prediction for DeFi for the next year. We can start with Konstantin and then just go around.
Crazy prediction for DeFi next year. I think that DeFi yields will be baked into the price of the base layer protocols over time. I don't know how crazy that is, but I feel like the yield that the whole concept around earning yield on layer 1 tokens is gonna ultimately connect to DeFi, and there's going to be much more price correlation between crazy tokens and base layer tokens.
Cool. Santiago?
Maybe Jack can go first.
All right, I'll take it. So I think, Kate, we're going to keep hitting these 3-point shots and these building complex DeFi primitives, but I think we're actually going to figure out the basics, and I think the amount of users in DeFi will grow 10x by the end of the year.
Sam, do you want to go?
Yeah, I think a ton of things are possible. I mean, I think it's possible that Ethereum will massively grow and rival Bitcoin, and some chance it even gets bigger. I also think there's a chance that Ethereum isn't even close to the biggest DeFi chain by the end of the year. I think those are both possibilities, despite being sort of like extremely different from each other. And I think that, like, you know, I also think it's possible that like DeFi will just crap out, and like in a year everyone will think this was like way premature and pretty silly, and like what the fuck were we doing? And at the same time, I think it's possible that, like, you know, the biggest application in the world a year from now will be on DeFi. And, you know, I think both those extremes are possible in both those cases, because I think that, like, DeFi has so much potential and is so poorly built relative to that right now that like it's sort of a race between people deciding that it's a piece of shit and it getting its act together and people realizing how much potential it could have. And, you know, I don't know how much impact that has on the long-term outcome of DeFi, but on the short to medium-term outcomes, I think it could be massive.
Yeah, I think we'll continue to see a multi-chain world where I think we'll start to see much more connectivity between chains, because I think that is how the world will evolve. My view is that we won't have one dominant, like this maximalism that exists in crypto is, to me, just doesn't make any sense, because there are certain application specific blockchains that are just going to thrive. And the really interesting thing that I think will be just the connectivity among these chains. And yeah, excited generally about, I think DeFi is here to stay, but there are scenarios where it just doesn't take off as much as we'd want it to. So you just sort of have to entertain and think probabilistically.
Cool. All right. Well, I appreciate everyone's time. I think this is a good panel. A little bit explosive, I guess, but it was fun. And appreciate everyone listening. And you know, this was recorded, so everyone can watch it from the recording as well. Thanks a lot, guys.
Bye, guys.
Thank you, guys.
Great.
See you.